If you had told me we'd have a week with CPI, Consumer Price Index, coming in at forecast with a big drop in housing costs, showing inflation is continuing to soften, with PPI, Producer Price Index, which measures average price change across goods and services, a gauge of future inflationary pressure, with PPI providing a core number in negative territory the first time since before the pandemic, and then retail sales, a measure of consumer spending and demand, with a headline number coming in well below forecast, I would have assumed massive improvements across our rate sheets. I mean, these three reports point to a slowdown in consumer spending, a drop in producer prices, and confirmation that inflation is continuing to trend lower. I mean, this is exactly what the Fed wants to see and should provide further justification for a pause in future rate hikes. It could be very beneficial for the bond market and certainly for mortgage rates. However, we did not end up with the improvements that you would expect. Now, the markets did react favorably on Wednesday and Thursday following the release of CPI and PPI. However, those improvements were basically gone by the end of the day. Now, on Friday's retail sales data, we did not see these improvements. While headline retail sales showed a significant drop in consumer spending, core sale, which excludes cars, food, fuel, and building supplies, came in at forecast. I mean, one of the more resilient categories was non-store purchases, basically everything bought online. And perhaps this core reading was the surprise to the markets. Perhaps they were anticipating a more decisive shift in consumer behavior following the implosion and diminished confidence across our financial institutions. Now, Friday's report didn't reflect this change in behavior, and right or wrong, the markets may have reacted to the implication that continued consumer spending and demand may cause inflation to persist or, worst case, to pop back up. I mean, if we look back over the last 3 months of core retail sales, it reflects the highest 3-month average going back to early 2021. But now, even with this, CPI and PCE, the two most significant inflation metrics, are showing inflation continuing to fall. And as we have said many times, it all comes down to inflation. If inflation continues to trend towards the Fed's 2% targets, mortgage rates will trend lower as well. You have any questions about these headlines, about these rate trends, or if you're ready to discuss your pre-approval options? Let's talk.